I'll introduce you.
Okay.
This is Meb Faber. Meb is one of the people in the financial world that really impresses me the most, because he actually cares about data, he cares about history, and he goes back and he does his homework. He's got a website called the Idea Farm that looks at very seriously at a lot of investment research. So Meb, we tried to hire Meb
right.
several times.
Yeah. Well, great talk. Nothing like a little regressions in the morning to wake you up. I'm going to keep this short on my questions because I know the audience probably has a lot. I know there's some panels later in the day that I'll probably pepper you with a bunch. I'm going to start with just one, and I know we only have about 5-10 minutes for questions. You know, as you think about valuations being a headwind, and the forces in the market and where we are, you know, and I was reading the GMO piece last night, unfortunately after some wine, so it's a little fuzzy, but, you know, he talked a little bit about the potential that markets can even go a little bit higher before you have this correction. Is there any sort of catalyst that you see in the coming months that, you know, may be something where we say, you know what, this is one more thing we look for, or is it simply across all your indicators, the catalysts are already slapping you in the face, you know, you should be seeing it already? What are you looking for? Is there any sort of final tell in the coming months? Or
yeah, one of the things that we said even in 2000 and 2007 was that the typical way that bear markets occur is not that the catalyst is well known in advance. What happens is that prices decline, and then things that people were worrying about peripherally suddenly become of great concern. You know, we certainly saw that in, you know, in Bernanke's phrase, well, the subprime problem is contained, right? So people see things happening and they somewhat dispense with them. So it's not clear to me exactly what drives a shift in risk aversion. One of the things that we do see, which is spectacular to me, that people don't think of it as strong of a catalyst as it probably is the shift in Federal Reserve policy. I think that Janet Yellen doesn't have any particular affection for quantitative easing, nor do the other members of the Federal Reserve, aside from Bernanke. I think they tried it. They thought it would work, and the data has not supported that. One could have shown that in 2010 because changes in the stock market have very little relationship with subsequent GDP growth. There are not really strong wealth effects. But given that we've had this environment where the Federal Reserve has been very aggressive and, you know, we've pushed the balance sheet out, and mostly people have believed it, and people believed that there was some hope that it would work, not having seen that and seeing the Fed really shifting toward more macroprudential considerations like bank capital. And I think that's a very, very important thing. Don't get me wrong. I actually admire the Yellen Fed so far for shifting its focus from this madness toward more macroprudential things. I think we do have already what is likely to be something of a catalyst, which is just the removal of the psychotic, you know, upward pressure on speculative, you know, speculative tastes that haven't done anything for the vast majority of Americans.
Well, it's interesting because the timing of this conference could be interesting in retrospect. We're entering, if you're a cycles person, the worst 6 months period across the 4-year cycle. So if you combine the presidential cycle, the 4-year, and then the kind of worst 6 months of the year, starting May 1st, things are usually the worst. Next question, then I'm going to open it up. You know, you talked a lot about top-down, looking at markets, looking at the U.S. stock market in general, but I think you affect a lot of your long positions as stock picks, right? Traditional stock picker. What are you looking for? Is it that you're simply running screens, or are you talking to management? What are you looking for when you're doing stock picks? Are you just a value guy through and through, or are you looking at what's your approach?
Well, with everything in stocks, it really does come down to that iron law of investing. And the iron law of investing is that what you are paying for is a stream of cash flows that will be delivered into your hands over time. And so when you look at that problem, you have to ask yourself a few questions. You don't just look at current earnings, right? Because current earnings, I don't know if everyone remembers Salton, but George Foreman grills came out, and there was a very, very rapid acceleration in adoption to the point where everybody had a Salton grill. But at that point, you had saturated the market, and so people were looking at adoption and the growth rate of that as if it was permanent. So we can't just be quantitative and say, well, look, the growth rate is this. Right? We have to ask the question, what are the cash flows that we're expecting to get over a long period of time? So we do care about revenues a lot. We do care about profit margins a lot. We care about return on invested capital a great deal. But we also do look at, what ends up happening is that we have quantitative screens of value, of market action, and of sponsorship. You don't want to see a stock that you think is a great value dropping like a rock, because that usually says somebody knows something you don't. I lost a summer's worth of day camp counselor earnings early in my career by doing just that with Wang Labs Class B. It looked great it looked amazing on the value line sheet, and it was dropping like a rock, and it wasn't clear to me that somebody knew something I didn't. Right? So we care about market action as a way to validate our beliefs about fundamentals. We look at, we do a lot of discounted cash flow analysis. We don't talk about it much because it's one of our, it's one of our competitive advantages. And if you look at our stock selection record, it I think holds up well. But then what we do is, after we get a quantitative look, we actually ask the question, do I believe this? And that question, do I believe this, is the second part of good stock selection. Because if you're just quantitative, you're going to find all kinds of Saltons. Right? You're going to find all kinds of companies that have had enormous growth based on adoption of their products. But when you ask the question, are people going to be spending on this company the same way 10 years from now or 15 years from now? And can I rely on the competitive landscape not to shift dramatically? That's where you start getting away from stocks that end up being sort of shooting stars.
I actually had one of those Foreman grills. All right. I'm going to open it up to audience questions. I think we have time for a few. Speak up, I'll repeat it, and then we'll go from there.
Can you think of any examples where things have looked mean reverting for a long period of time, and then after a couple decades break out? So they lead you to believe that they have this pattern, and then the world changes.
Yeah, individual indicators do that a lot. Short interest did that. If you looked at NYSE short interest, for a good amount of time, it was a reasonably good indicator of stock of subsequent returns. And then as the environment shifted and you got a lot more short sales being matched against longs, right? You started seeing changes in that structure in a way that it became unuseful. And really the question that we always ask, and we ask it much more than people think, is, has the structure of things changed? Right? So, one of the common arguments about profit margins is, well, there are more foreign revenues and companies are earning more overseas, and so that's really what's driving that. But if you actually go in and you look at, you impute foreign revenues, based on the profits that companies are bringing home, and then you do the same kinds of analysis, you really don't see any shift in those dynamics. So the real question to always ask when you're looking at indicators, particularly when you're looking at indicators that you care about, is there something that's changed in the structure that makes me worry about the reliability of this? A good example that doesn't quite touch on mean reversion, but it's very important, is Marty Zweig used to look at interest rate indicators as one of his primary methods of evaluating stock market prospects, because in the inflationary world, right, falling interest rates being lower than they were 6 months ago and so forth, was a very good thing. The problem is that when you got into a world where people were scared about deflation, were scared about credit, and were running to safe havens in treasuries and so forth, what you found was that you couldn't use those same treasury yields to do good stock market analysis, because plunging treasury yields were one of the strongest signs that credit risks were going up and that the economy was going into the tank. And so a lot of those indicators that he used, prior to 2000 ended up breaking down very badly in the 2000 to 2002 bear market, 2007 to 2009. So the question to always ask is, do I believe this from the standpoint of, is there something structurally that's changed to make me worry that this measure isn't accurate? And then you go to the data, and our second biggest expense next to payroll is data, because we insist on understanding.
All right, Bob?
Yeah, John, thank you. You talked about the fact that corporate profits are a mirror image of deficits in other sectors, but
yes,
with the Kalecki equation, in federal deficits now, I think, have been shrinking for about a year. Why isn't that showing up yet in profit margin?
Yeah.
And let me repeat the question just so they can hear it. The question is, if the deficit's been shrinking, why isn't that showing up in profit margins?
Right. So, so the chart that I show with basically household and government savings is actually something of a reduction of the full Kalecki equation. In order to look at it entirely, you have to look at investment and foreign savings, basically the inverse of the trade of the current account deficit, and all of that actually goes together. In the United States, what ends up happening typically is that that changes in investment end up being largely a mirror image of changes in the current account deficit. So one of the things you'll always see is that in a recession, the current account deficit, our trade deficit, improves enormously, and people think that's good news, but it's almost always offset by an opposite reduction in gross domestic investment. Why is that important? It's important because in that dynamic, there's something of a lag effect. There's almost a J-curve-like effect. So what that induces in these, and you'll see it in some of my charts, you'll see a phrase that says lagged by 6 quarters, right? And what ends up happening is that those changes in household and government savings end up having some of their larger follow-on effects after a lag of about 6 quarters. So some of the improvement that we've seen is actually something that, if you push out 6 quarters, makes you worry about 2015 more than you worry about the next quarter or so. I hope that helps.
JJ, time for a few more? One more, and then we'll catch the rest of these in the...
John, I'm curious, is the applicability for the future return calculations that you use on U.S. markets just as applicable when you look at foreign markets?
Yeah, you have to do a little more work in terms of figuring out what those norms are. The problem is with some of the more developing markets, you have a shorter history, so it's very, very difficult to get a good read on what kind of reversion you can use. Bill Hester does a great deal of work on that side, because he helps us manage one of the funds that focuses on international, and we do see kind of the same things. Bill, do you have like a 10-second response to that is worth sharing?
You can calculate these returns, and we do internally. It's just more challenging. The MSCI data goes back to about 1970, and there's quite a bit more volatility in those earnings.
Sorry to put you on the spot.
Thank you.
I'm up in a couple sessions, but I want to pass around this quick questionnaire. I want to explain it now so I have time to add it up. One quick question to answer is, what percentage of your portfolio, and this is just stocks, so exclude bonds, exclude real estate, exclude commodities, what percentage of your portfolio is in the U.S.? And if you're from somewhere else, Denmark, if you're from Singapore, what percent's in your home country? All right, it's anonymous, so I'll send this around.
Okay. And just give John a thank you.